because of the behavior of the market, defining these structures so clearly on momentum, it's our experience that whenever a market creates a very clear momentum structure, it's for a purpose of using it as a starting gate in a new direction. And so right now we get the stock market dancing above what is a sell structure, and silver and gold miners dancing just below with precision. That weekly close in silver in November was a penny and a half below the breakout number, below an upside breakout number. And our number for silver was 25.36 weekly close. Well, if you go back and look at the peak weekly close in November, it stopped at 25.34.40, 25.344. Okay, penny and a half below our number. Didn't close above it, and then immediately dropped. So silver did not validate what gold had indicated on the same metric, the three-quarter moving average situation. Nor did, for instance, GDX. We had a number for GDX at 35.90 plus. It stopped at 35.08 and pulled back. Now, what's neat about those two markets, the miners and silver, in terms of re-engaging to the upside, is that those trigger numbers that they set up got so close to them on momentum and then pull back. Therefore, it's set like building a bridge, so to speak, building a structure. It's set a level that is now going to drop next quarter because those averages, three-quarter moving average, for example, in silver and GDX, is going to drop some. Why? Because we're lower than we were 3 quarters ago. Okay. The breakout levels on silver instead of 25.36 is now going to be around 24.40 weekly close, which if you look at a price chart, doesn't mean anything. Why? Because we're up in the mid-25s, so mid-24s doesn't mean much, but for us, it's a major breakout. It suggests to us that if we see silver do that and see like GDX get up to 34.40, those other components of the gold-silver complex are saying now we're in agreement with gold. The question now is, though, gold pulled back sharply after that seemingly false breakout, which wasn't validated by silver or the miners. So it was a breakout that we acknowledged, but we didn't endorse. Okay, it pulled back sharply enough to where it hit some numbers a week ago that bothered us. It suggested there's the potential, and we emphasized a big question mark. We expressed some doubt, which we normally don't do. Okay, that gold might have a sharp sell-off here. If it's going to do it, it has to do it soon. In other words, you can't just have that sharp drop we had a week or two ago and then just start to gel. If you do, like we're doing now this week, we're gelling. Like we're steady as a rock. You get into next week and we still haven't broken down sharply. We're not gonna, I don't think. I think all gold is doing is saying, oh, I broke out prematurely. Now I'm going to wait for my sister and the miners to agree with me. And once we get into next quarter, which is 12 trading days away, all the numbers will shift. And we think we could get a unison type of signal from gold reasserting itself again back above certain levels. Silver, the number I gave you, it's an estimate right now, but it won't change much. And the miners all saying, okay, we're with you now. And at that point, we cross those numbers. I think the entire complex is saying what we've seen since last summer's high, August high, is a lot of violent turmoil up and down. And at the worst point, gold was down 20% from its high. I mean, think about it. It took them 9 months to get it 20% pullback. The S&P's done that 5 times during its bull market and done it 2 months, And now gold's sort of almost in the middle of that range, just below 1,800. And silver's, in the lower half of the range it's been in for the last year or so, which is roughly 21 and a half up to 30. So it's trading 22 and a half. Maybe it'll be 23, 24 here shortly. So we think that congestion zone will end if we can cross those numbers. And it's going to be a next quarter event, which means start watching closely as we get into January for those numbers to be triggered. And if that happens, I think that whole complex wakes up again and we start to move back to where the price guys, we're only looking at GDX price chart or silver price chart, we'll say, hey, it's reborn. What's that going to take? Well, you can look at a silver chart, go back to last summer, and you'll see there were a couple rally highs where look just at the weekly closes. And the weekly closes peaked around 28. You get back above 28, I think the price guys are going to start to wake up and say, oh, it's born again. We think it's born again somewhere just in the mid-24s. So anyway, we're watching very carefully. That's what we think is going on there.
Michael, I interviewed you first earlier this year, was my first interview with you. And you said at that time, and you said on other shows as well, that we could see $8,000 gold by the end of next year and maybe $200 silver. Is that still within the realm of possibility, or have you adjusted that?
No, I've not adjusted it. If we reemerge here, what I'm looking at are those trigger numbers. If we engage those quarterly momentum trigger numbers, it tells me that this congestion zone was in fact a congestion zone. It was not a top. And that all these metals and the miners are going to be reborn and move up out of these congestion zones. When we made the statement about $8,000 gold, it really wasn't outlandish. If you go back and look at the prior 3 bull markets in gold and measure each of the bull markets from the bear market low that preceded the bull market, they were roughly 8-fold moves, early 70s to mid 70s, 76 low to 1980 high, 2002 to 2011. They're like 8-fold moves. Well, our last bear market low was 1,046. All we've done is double so far. If you go up 8 bull, you made $8,000. And that's just replicating the logarithmic scale of the prior 3 bull trends. But we think there's bigger things going on out there. And I suspect most of your listeners would tend to agree. Bigger things meaning bigger compounded errors in the system generated by central bank policy that's been ongoing this time for more than a dozen years, where they've rammed rates, entered the cost of money. They've priced the cost of the main commodity asset in the world, money, that which people interrelate with, off the page. It's just like pricing steak at zero. Okay, everybody gets free steaks. Okay, well, anyway, when you price money below reality and you do it for a long time, there's got to be compounded errors all over the place where businesses make decisions on assumptions based on what? Cost of money is a major factor. So they commit to hiring more people, building more factories on the assumption that it's going to stay this way, that somehow reality can be fixed that way. So over a dozen years, we've had this boom, biggest boom in U.S. stock market history, generated by effectively zero rates. Fed funds rates been back up to 2% and back down near zero again for a dozen years now. And if you get a Fed funds chart, I suggest you go to St. Louis Fed on the internet and just type in Fed funds chart and take a look at it. Go back 30, 40 years. And you see all these upwards and downwards, and then overlay that on an S&P chart. And you can see whenever they depress that money rate, because we've had a bust, it's always the end of a bust, they try to create another boom, that depress the money, cost of money, and the liquidity, the amount of money in the M2 charts, for example. Then the markets go back up. And the chief beneficiary and the one they want to benefit, of course, is the stock market and corporate bonds in particular, because those are vital to the economy. And so that's what they're really concerned about, is effectively inflating the price of stocks artificially, with artificially low money rates and a river flow of money that now the money supply that is growing exponentially. It's not just us, it's the BOJ and it's the ECB as well. They're engaged in the same policy. In fact, they're not flinching quite as much as the Fed has argued they're going to flinch. Our primary focus is, again, on the stock market, the debt markets, and in the commodity arena, it's on energy, grains, but especially gold and silver.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. The fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really, really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. there is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.